Ever wonder how top financial analysts take just this absolute mountain of dry, boring data and somehow turn it into a compelling $1 million buy or sell recommendation?
Yeah, it's quite the process.
Right, like
Yeah,
you picture these folks just staring at endless spreadsheets on Wall Street, but eventually all those raw numbers have to become a narrative, a
exactly.
story that actually convinces an institutional investor to, move serious money.
It really is a translation process. You're starting with thousands of rows of raw, unformatted data, and you're distilling it down to a single, actionable conviction.
Right. And the mission for our deep dive today is to figure out the actual mechanics of that translation. We are unpacking the NISM Research Analyst Workbook, specifically focusing on Chapter 13, which is titled Qualities of a Good Research Report.
It's a fantastic chapter.
It really is. Okay, let's unpack this, because the core premise here fundamentally shifts how you should think about financial analysis.
How so?
Well, there's this pervasive idea that the best analysts just have an inside scoop, right?
Yeah.
Like they have secret access to better information than the rest of the market.
Yeah. That's really a lingering myth from decades ago.
Yeah.
I mean, in today's regulatory environment, information parity is the rule.
Exactly. According to the source material, every analyst basically has access to the exact same information at the exact same time.
Yeah, they're all pulling the same 10K annual reports.
Right, listening to the same quarterly earnings calls, looking at the same public market pricing. So what makes a superstar analyst stand out isn't the proprietary data they possess.
No, not at all.
It's how they structure and communicate the data everyone already has.
We tend to view financial analysis as this purely mathematical endeavor. Like you're just building a discounted cash flow model and blindly trusting whatever output it spits out.
Right, just let the spreadsheet do the work.
But writing a highly effective research report is actually a highly creative process. It's really an exercise in narrative architecture.
Narrative architecture, I like that.
Yeah, it's the art of taking these complex, often really intimidating financial metrics and translating them into a cohesive view that drives action.
Because if your reader can't easily follow the logic of your brilliant financial model, then the model is essentially useless, right?
Exactly. You have to convert numbers into a definitive perspective.
Which, I mean, that makes the actual structure of the report incredibly critical.
Oh, absolutely.
If the goal is converting public numbers into a unique perspective, how does an analyst actually blueprint this avalanche of information? Because, let's be real, if you just dump a 10K into a Word document, you're going to put your reader straight to sleep.
You definitely are. So the workbook outlines a very disciplined three-step workflow. It's planning, drafting, and editing.
Okay, which sounds like elementary school writing advice.
It does, but context is everything here. During a busy quarterly earnings season, an analyst is often churning out dozens of these reports in just a matter of weeks.
Oh, dozens.
Yeah. So without strict architectural discipline, that workload creates this cascading effect of delays, cognitive fatigue, and ultimately really sloppy recommendations.
That makes a lot of sense.
But the real secret to the report's architecture lies in compartmentalization. They strictly divide the report into fact-based sections and view-based sections.
Okay, let's drill down into that compartmentalization. Facts seem straightforward enough, right? These are the raw materials.
Exactly.
I'm assuming we're talking about things like revenue figures, shareholding patterns, debt loads, maybe peer group comparisons sourced directly from the annual reports. It's objective reality.
Precisely. For an analyst, drafting the fact-based section is largely a matter of curation and, crucially, data visualization.
Oh, right. Charts and graphs.
Yeah, it's the objective reality of the company's past and present. Visual charts are vastly superior to just written numbers.
But the view-based sections are different.
Very different. View-based sections demand personal synthesis. This is where the analyst describes the nuances of the business model, identifies hidden structural strengths or, looming concerns.
So things you can't just scrape from a database.
Right. You have to synthesize management commentary, supply chain dynamics, consumer behavior, all to form a perspective on the future industry outlook.
Gotcha. So it's essentially like building a house.
Okay, I like where this is going.
The fact-based sections are the foundation, the framing, the plumbing, the structural stuff that has to be scientifically sound and objectively true. If the plumbing leaks, the whole house is ruined.
Yes, exactly.
But the view-based sections are the interior design and the flow of the rooms. That's the subjective, creative part that actually makes you want to live there, or in this case, actually convinces someone to buy the stock.
That analogy captures the dynamic perfectly. The foundation supports the design.
Right.
And just as a master architect knows that empty space is as important as the walls, a top-tier analyst knows exactly what to exclude.
Oh, interesting. What do they leave out?
Well, what's fascinating here is the list of exclusions. The workbook explicitly warns against including broad commentaries on general market trends, macroeconomic theories, or political conditions in these specific stock reports.
Wait, really? I would have assumed talking about the macroeconomy like, say, interest rates or inflation
Mm.
would be crucial context for pitching a stock. Why strip all that out?
Because it dilutes the core thesis.
Oh, I see.
Yeah, if an institutional client is reading your report on a mid-cap software company, they do not want to wade through 3 pages of your personal theories on the Federal Reserve's next rate hike.
Right, they probably have their own macroeconomists for that anyway.
Exactly. The focus must remain sharply on the microeconomics of this specific investment idea. The ultimate goal is clarity.
Which ties back to the data visualization you mentioned earlier?
Yes, a well-designed chart showing a 5-year margin trend is vastly superior to a dense paragraph listing those same percentages. The human brain just processes that visual slope in a fraction of a second.
That structural rigor makes a ton of sense. But it also leads directly to the obvious question. What happens when the architecture fails?
It definitely does fail sometimes.
You mentioned earlier that overly complex language causes a report to fail. Is that why the financial industry relies so heavily on those standardized, rigid rating conventions at the end of every report?
Yep.
To strip out the ambiguity?
Yes, absolutely. Ambiguity is the enemy of action. The source text actually highlights that reports generally fail due to unnecessary details, long meandering sentences, and inconsistent views.
Inconsistent views. Like what?
Like praising a company's cash flow on page 2, but quietly worrying about their liquidity on page 5.
Yeah, that would be confusing.
Right. So to combat this, the industry anchors the entire narrative to highly specific rating conventions.
Right, and for an audience that follows the market, you see buy, hold, and sell all the time.
Yeah.
But the workbook actually puts rigid, industry standard timelines and percentages to these terms to enforce accountability, right?
Now, it does. It's not just a feeling. When an analyst issues an absolute buy recommendation, they aren't just saying, hey, I like this company.
Right, they're putting numbers to it.
Exactly. They are stating a firm expectation that the stock will deliver more than a 10% return over the next 12 months.
Okay, so more than 10% in a year. What about a hold?
A hold signals an expected return ranging between negative 10% and positive 10% over that same 12-month period. It's essentially dead money.
And a sell.
A sell is a hard projection of an expected return of less than negative 10%.
Okay, having that 12-month 10% benchmark is crucial because it gives the reader a way to grade the analyst's homework later.
Precisely. You can look back a year later and see if they were right.
But the workbook also dives into relative ratings, which I think are far more interesting for actual portfolio construction. Terms like outperformer or overweight versus underweight.
Yes, relative ratings are key.
Let's walk through the mechanics of that. Because, wait, so if a stock is overweight, it doesn't mean the company is bloated with too much debt. It just means it's going to perform better than the market.
Right, exactly. It has nothing to do with the company's debt load. These relative terms describe performance relative to the market, and they speak directly to the institutional investors actually moving the money.
Okay, how does that work in practice?
Let's say a fund manager's benchmark index, like the S&P 500, is currently composed of, say, 5% in a specific tech stock.
Okay, 5%.
If the analyst believes this tech stock will grow by 8%, while the broader index will only grow by 5%, they issue an overweight rating.
So they're telling the portfolio manager, hey, if your benchmark dictates you should hold 5% of this stock, you should actually hold 7% or 8% to capture that outperformance.
Correct. You are literally weighting it heavier in your portfolio than the market average.
Okay, and I'm guessing underweight is just the exact opposite.
Exactly. Underweight means the stock will likely lag the broader market average. So even if the stock might go up slightly, it's a poor use of capital compared to other opportunities. You should hold less of it than the index dictates.
These standardized conventions are vital because they force the analyst to take a definitive stand.
They do. You really can't hide behind a beautifully written 30-page narrative.
Right, because the rating at the top of the page translates all that qualitative research into a quantitative, measurable prediction.
Exactly.
But managing all these rigid requirements like the 10% absolute thresholds, the relative portfolio weightings, separating the facts from the views, all while simultaneously processing a flood of quarterly 10K data, it just seems like a recipe for a massive slip-up.
It can be. It's a lot to juggle.
When you're running on fumes during earnings season, how do analysts prevent themselves from making catastrophic errors in their models?
The solution to managing that cognitive load is surprisingly analog. It's the strict enforcement of a checklist-based approach.
A checklist, really?
Yes. When you're drowning in an ocean of complex information and you're under extreme time pressure to issue a rating that might move millions of dollars, human psychology tends to default to disorganized emotional decision-making.
Yeah, panic basically sets in.
Exactly. A formal checklist serves as a circuit breaker for that panic.
The workbook specifically references Dr. Atul Gawande's framework from his book, The Checklist Manifesto.
It's a fantastic book.
It is, and he makes a distinction there that I think applies perfectly to financial modeling. He divides human errors into two distinct categories: errors of ignorance and errors of ineptitude.
It's a vital distinction. An error of ignorance is a mistake made because we simply lack the knowledge.
Right, you just don't know enough.
Yeah. For example, if a new, highly complex financial derivative hits the market and an analyst misprices it because the mathematical models haven't even been fully developed yet, that is an error of ignorance. We can forgive that.
But an error of ineptitude is when you make a mistake despite having all the necessary knowledge.
Exactly. You knew the right thing to do, but you bypassed a step, got distracted, or let your biases take over.
If you're listening to this and you've ever spent like 3 hours tweaking a complex spreadsheet model for work, only to realize the next morning you forgot to drag a formula down one single row, throwing the whole calculation off, the physical pain of an error of ineptitude.
Oh, it is the worst feeling.
It really is. In finance, missing a massive red flag in a company's off-balance sheet debt usually isn't because the analyst didn't know how to read a balance sheet. It's because they didn't systematically check it.
Right. The checklist eliminates those lazy, systemic mistakes. It forces the analyst to confront the data they already know they are supposed to verify.
That makes sense.
And furthermore, it leaves a clear decision-making trail that can be reviewed later. If a buy recommendation goes terribly wrong 6 months later, the analyst and their firm can review the checklist to see exactly where the thesis broke down.
Okay, here's where it gets really interesting, but I have to push back a bit.
Sure, go ahead.
We started this deep dive by agreeing that writing a phenomenal research report is a highly creative process of translating numbers into a compelling view.
Yes, we did.
Doesn't a rigid, mandatory checklist stifle that exact creativity? I mean, it sounds like we're turning a nuanced, view-based process into a robotic grocery list. Check the revenue, check the debt, write the report. Where is the room for creative synthesis?
It's a common critique, but think about how Gawande applies this to airline pilots.
Okay.
Commercial pilots run through exhaustive, mandatory checklists before every single flight. Does that make the act of flying the plane uncreative or purely robotic?
I guess not.
No. What the checklist does is handle the routine, critical safety measures automatically. By offloading those mandatory checks to a piece of paper, it frees up the pilot's cognitive bandwidth to deal with the unexpected like sudden weather shifts or air traffic anomalies.
Ah, I see. So for the analyst, checking the debt-to-equity ratio on a list isn't the job, it's the safety check. It frees up their mind to spot the larger narrative or the hidden moat. The checklist doesn't kill creativity. It prevents errors of ineptitude so creativity can thrive safely.
Precisely.
Yeah.
Which brings us to the actual contents of that safety check.
Yes. What is actually on this ultimate checklist?
Well, the workbook provides a sample checklist for investment research reports, and it breaks the workflow down into 3 distinct categories: qualitative parameters, quantitative parameters, and valuation parameters.
Let's unpack the qualitative stuff first, which ties directly back to those view-based sections we discussed.
Right.
The very first question on this ultimate checklist is deceivingly simple. Do I understand the business?
It sounds so basic, right?
It does, but if you can't succinctly explain how a company actually generates its cash flow, you have absolutely no business assigning an overweight rating to it.
It acts as an immediate filter. The qualitative section also forces the analyst to ask things like, is the product a necessity or a choice?
Meaning, will people still buy it during a recession?
Exactly. Or is it a luxury item that will see its revenue evaporate if the macroeconomy tightens? It also demands an assessment of the company's moat, the structural competitive advantage that protects its margins from rivals.
And that leads to arguably the most profound question on the entire checklist.
Hmm.
The text literally asks the analyst to answer, can a fool or an idiot run this business?
Yeah, it is bluntly phrased, but from a risk assessment standpoint, it's brilliant.
I love it. It makes total sense when you think about fragility versus robustness. I look at it like automotive engineering.
Okay. Oh,
A
kind of.
truly robust business is like a car engineered with such incredible safety features, autonomous braking, and perfect handling that it almost doesn't matter if a bad driver gets behind the wheel. The car is still going to get safely down the road.
That's a great way to look at it.
Right. But if a business model requires a once-in-a-generation visionary CEO just to barely turn a 2% profit, that is a highly fragile investment. The moat should be so deep and the product so necessary that even mediocre management can't destroy the cash flow.
That is the exact mechanism they are testing for. You want a business model that survives the inevitable departure of its star executives.
Absolutely.
But once you've established that qualitative robustness, the checklist forces you into the quantitative parameters. This is where you verify the beautiful narrative with unforgiving facts.
Right. This is where we get into the heavy metrics. The checklist demands that analysts look for consistent revenue growth and specific metrics like a return on equity or RE and a return on capital employed ROC.
Yes, and the checklist specifically looks for an ROE and ROCE continuously greater than 15% over a 5-year period.
I'm assuming that 15% benchmark isn't just an arbitrary number picked out of a hat. It's about proving the company is actually compounding wealth faster than their cost of capital, right?
That is the underlying math, yes.
Huh.
Return on equity measures how efficiently a company generates profits from the money shareholders have invested. And return on capital employed takes it a step further by factoring in debt. If those numbers aren't consistently clearing that 15% hurdle over a 5-year span, which, by the way, typically covers a full business cycle of ups and downs, it means the company is likely destroying value, regardless of how great their product is.
Wow. The checklist also strictly looks at leverage, specifically demanding a debt-to-equity ratio of less than 1.
Very important.
We know leverage amplifies gains, but it equally amplifies losses. By capping the acceptable debt-to-equity at less than 1, the checklist prevents the analyst from falling in love with a company that is essentially just using borrowed bank money to artificially inflate its growth.
Exactly. You are systematically screening out companies that could face major liquidity crises during a credit crunch.
Makes total sense.
And this quantitative rigor leads directly into the final, most critical category: valuation parameters.
The price tag.
Right. You can find a company with a brilliant moat, idiot-proof management, and a 20% ROE. But if the stock price is too high, it's still a terrible investment.
Which brings us to the concept of intrinsic value and the absolute necessity of establishing a margin of safety.
Yes.
The checklist requires the analyst to justify this margin of safety. I want to upgrade an analogy I usually use for this.
Let's hear it.
People often think of a margin of safety like packing a spare tire for a road trip. You hope you don't need it, but it saves you if things go wrong.
Sure.
But in financial modeling, it's highly mathematical. If an analyst builds a complex discounted cash flow model projecting out 10 years of earnings and determines the intrinsic value of the stock is exactly $100 per share, they don't issue a buy rating when the stock is trading at $99.
No, absolutely not, because doing so assumes their 10-year projection is flawlessly accurate, which is impossible.
Right. They might demand a 30% margin of safety, meaning they won't issue that buy rating unless the stock is actually trading at $70.
Exactly.
That $30 gap is the actual margin. It absorbs the shock if their growth assumptions were slightly overly optimistic, or if a competitor unexpectedly takes market share. The checklist forces them to quantify that discount before they publish.
If we connect this to the bigger picture, it becomes clear why this structured approach is mandatory.
Definitely.
Answering these specific checklist questions objectively about the qualitative moat, the quantitative ROE, and the mathematical margin of safety is what truly separates a robust, Grammy-worthy research report from a flimsy guess. The analyst is binding the creative, view-based narrative with the unforgiving discipline of quantitative facts.
We've covered a tremendous amount of ground today. To synthesize the blueprint of a top-tier deep dive report, it requires separating your objective facts from your subjective views to build a coherent structure.
Right.
It demands shedding complex jargon in favor of clear, standardized ratings like absolute 12-month returns or relative portfolio overweights to guide the investor. And above all, it relies on a strict checklist to prevent those devastating errors of ineptitude when the pressure is highest.
What I hope you, the listener, takes away from this is that this framework extends far beyond Wall Street equity research.
Oh, for sure.
The architecture of a good decision is universal. Whether you're prepping a massive quarterly strategy deck for your executive team, evaluating a new software vendor, or even making a major life purchase like a home, separating your undeniable facts from your synthesized views is incredibly clarifying.
It really is.
And implementing a Gowanda-style checklist in your own professional life is the single most effective way to prevent errors of ineptitude when the stakes are high.
We can all definitely benefit from applying a little analyst rigor to our own lives, but I want to leave you with a provocative thought to ponder long after we wrap up today.
Okay.
We are rapidly entering a world where artificial intelligence can instantly crunch all the quantitative metrics. An AI can calculate a 5-year ROCE, verify a debt-to-equity ratio, and generate the entire fact-based foundation of a report in milliseconds.
It's true. It's happening right now.
So, as that technology scales, will the true premium value of human intelligence soon rely almost entirely on our subjective view-based creativity? Will the ultimate edge of a superstar analyst simply be their uniquely human ability to sit back, look at the messy reality of the world, and answer the question, could an idiot run this business?
It's the ultimate test of where human judgment still holds the high ground.
Thanks for joining us on this deep dive. Until next time, keep asking the big questions.